Hey guys, so I want to do a quick deep dive of a tweet that Michael Burry did about 5 days ago. It's a pretty interesting tweet, and I just want to do a quick video and deep dive a little bit into what it is that he's saying, what is implied, because it's a very vague tweet, and some people may take away some stuff and essentially jump into conclusion on what it is he's trying to say. So I do want to do a quick deep dive to see if what people are jumping to conclusion is essentially true, or if Michael Burry is just highlighting something and we're just kind of going and running away with it. So let's dive into it. So this is the tweet. It says maybe with period, and he highlights a time frame of 2000, 2001, and 2002 till 2003, and it's essentially an interesting time in the market at the time. So let's go into it. So first, let's look at this chart. It's a technical indicator perspective. And again, Michael Burry, he uses several things here, some indicators that are interesting. So first I'll point out is the simple moving average 50, 50 days average, 100 days simple moving average in green, 200 days simple moving average in yellow. So each one of those simple moving average will serve as indicators, and they essentially, he essentially uses simple moving average because it serves better for long-term investors. I myself am a trader. I use exponential moving average because it's weighted to the most recent data, and I like it short-term and whatnot. But for somebody who's managing a large amount of money and who is long-term investor, who doesn't want to deal with all the tax implications of realizing gains and everything like that, and they're more of a, buy and hold, short and hold, it's likely much better to use simple moving average. So he does use simple moving average here, 50, 100, and 200. So the first thing is, notice how this is from 2000 to 2003. As you know, first, that is an interesting time because market is definitely volatile around that time. So that's after the 2000 .com boom. And then second, after that, it's the post 9/11 era, which shortly after has a bearish downturn that implied for a longer term duration bear market. And that's interesting because it happened right after a very bullish multi-year rally going into the 2000s. And here's the downturn. So keep that in mind, just because, again, that's an interesting time. It sort of, kind of mirrors what's happening now, because we just got off a multi-year bull market run, led by tech stocks, led by EV and whatnot. So it has some similarities here. And then the second one is, keep in mind that the market's always unique. So what happened then does not exactly indicate that it's going to happen now. The term unique is that anything can happen. So this is just a simple study and a deep dive. So here in the simple moving average and the indicator column here that he highlights, what is interesting is, if you are an investor or a trader, you always look for some kind of crossing here. So if you look in the early section, here the simple moving average 50 crossed the simple moving average 100. So if you're an investor or if you're a trader, you always look for a cross, whether it's for an entry to a short or an entry to a long. This was essentially a simple moving average 50 leading down, crossing average today, crossing down with the 100 simple moving average. Likely would have served as a phenomenal time for a short. And again, knowing the market then, this then went straight down. So what he highlighted here
starting with a circle here,
straight
the drawdown here.
So what you highlighted,
and then it moved up back to
starting with a circle here is
50 after being extended down,
drawdown here,
and
then it moved up back to right 50 being extended down, and then moved across here to 100, which would have been a good long entry. But it sort of tops about the SMA 200, and again,
market chops around, tops again at 200, and once again, this crosses here when it's all convoluted and all together to start then moved led by SMA 50 down to the downside, and it starts dropping down, which shows the full bear market there. So what does it mean? Again, we don't know. It could signify something. The market today could move potentially like this, or it could not. But that's why we're making this video now.
Convoluted all together, then move that 50 down to the downside, and stuff like that, which shows the full bear market. So you don't have to take move like this.
So here's the
video now. So I want to make sure that we are on this too.
Using the same color coding, which is the purple is SMA, the green is SMA 1,
so here's the S&P 500,
and the yellow,
so
which
is the purple is S&P, and then the you barely see the S&P 200. So the first one is the cross here as again indicates a phenomenal time to enter, and this would be a good time to enter short.
And from then on,
it would have been a phenomenal entry for short, and would have made a lot of money then at that time. And then once again, it
bounces around,
moves down, whatnot. What's interesting is again it tops here when it moved up
at the
SMA 200 level, and then it moves down again, led by SMA 100 this time, while the SMA 50 is still down below the SMA 100, so it was still signifying a bearish run. And again, this led by SMA 100, and then moves up again, nearing the SMA 200, it moved above the SMA 100, but nearing the SMA 200. And again, market has been trading around this area, and then now it starts to move up here. And today, as of January 27th, on Friday, it led a strong bull run here. And if we're using Burry's comparison, it looks like it is about to go up, and we're nearing a key level here at the SMA 200, around the 4200 mark. So what does it mean? Right now, the market is at 4070. So it could move up to the 4200 level, but what you got to be aware of is when it nears the key level here, it usually tops. And if it does top, what Michael Burry signified using the 2002-2003 is that it could lead to a bigger downside bearish run. And again, is it possible? Yes. But is it likely? Who knows? Only time will tell. But right now, what it signifies is that, again, using his method, is SMA 200 is showing that it serves as a good top, and then we're looking at SMA 100 here and SMA 50. What would happen for 4070 to go to 200 is SMA 50 is going to cross over the SMA 100, which signifies for a bullish entry. But then it may likely top at the 4200 using Michael Burry's analogy. Once again, we look at Michael Burry's
SMA 200 at the top here,
and
then led by the short term 50 after a quick crossover and chop around.
After a quick crossover and then down here at 200 once again. As it trends down, it serves as a good top of where it's going.
Now some
dissimilarities, some things are not similar. you can see that SMA 200 was essentially
on a downward trajectory,
as well as the SMA 50, SMA 100, right? But if you look at ours, what's happening right now is that SMA 200 is not really on a downward trajectory. It looks like it's more of just an oval shape. Now, could it lead to a downward trajectory? Of course. Yeah, it could be pulled down by the price action, and it could lead to a downward trajectory, which shows that it would be a duration bearish market. But if you look at if we just go back again, I mean, we've been essentially fortunate about the bullish run. But then, if you look at it, it's been kind of just chopping around here, and short of our 3,500 level down here, which, people were freaking out at the time. And again, this was, because of the rate adjustment and whatnot. But I think that there's a little bit of similarities when it comes to wanting to signal a historical bearish market. And again, I'm a trader, so I look for something in the short term. I don't hold stuff too long overnight, risk management purposes, especially at this time. And so there's too many dissimilarities, one, and then two, the market is unique. And the term unique, again, one signifies that it's never happened before. Any given market moment is essentially a unique event that just has never happened before. That's a mindset that's got to be built in. So for all we know, it could be one, it could lead to a historic downside, like Michael Burry might have implied, or two, it could be a massive bull run once it breaks the 4,200, and it could be a historic bull run, or three, they could just trade sideways around SMA 50, 100, and 200 for a while. So, with the uniqueness of market, there's no way to tell what could happen in the long term or downturn, or long term or short term. So, take it with a grain of salt. I do like and respect Burry a lot, just because he is a thought leader. I mean, he was able to identify that catalyst during the Big Short movie. So if we were to experience downside here, like this was essentially marched into by serious catalysts. For example, at the time, the downturn of 2002 was accounting fraud led by Enron. And this was, again, the background, this downturn can be part of a larger bear market, or correction, again in 2000. The collapse of Enron is a prime example. Internet companies went bankrupt, and others on eBay and Yahoo went down dramatically in value, but remained in business. Outbreak of accounting scandals, September 11 attacks. Again, there was just so many catalysts to drive that market down to have the correction. So for us to right now have that similar downturn, we would need catalysts. We would need extreme catalysts. Now it could be anything. It could be the Russian-Ukraine war. It could be World War III, IV. I mean, heck, it could be anything to kind of lead that. It could be another outbreak of a virus. Who knows? But essentially, it would need an extreme catalyst to drive that market down. And the thing with catalysts is it could be also positive catalysts to drive the market up. So you would have to be mindful of catalysts, not just the price action, to learn what is happening. So anyway, hope you enjoyed this. Hope this really added some value. If you do like it, click like and subscribe. Thank you.